And welcome into the Organized Investor Show, brought to you by Tennessee Wealth Management, the show that helps you stop guessing and start knowing exactly what you own. It's me, your host, Erik Ainge. I want to open today with a confession that's going to make a few of you squirm. The single most common thing that walks through the door at Tennessee Wealth Management is not a confused investor, and it is not a scared investor. It's an investor who owns something they cannot name. That's right. They've got a statement, and it's super thick. They've been paying for it for years. And we ask them, now tell me what kind of account it actually is. Most of them can't do it. That, folks, is the entire show today. Knowing. We're calling it the account almost everybody has and no one can name. So let that one sink in. Let's bring the team in here because these are the people untangling this for a living. Right here with me, Jerry Goodman, for over 43 years in the business. He has been dominating, certified financial planner, a guy who has seen more market cycles than most investors have seen birthdays. We also have Megan Hubbard, Jerry's daughter, former first grade teacher over at CAK, has a master's in curriculum and instruction, which means she takes the confusing things in finance and explains it like a human being so all of us, especially me, can understand it. And my wife, Susan Ainge, the newest member of the team and the person in the studio whose job is to ask questions that you sitting home are thinking right now. As for me, Erik Ainge, former UT quarterback, played for the Jets, nice guy, enjoy long walks on the beach, blah, 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 you know, all that good stuff. Megan, you're kicking it off for us today. The floor is yours.
Thanks, Erik. I want everybody at home to do something with me right now, okay? So fun little exercise. Go find your most recent investment statement, you know, the one that you usually file away without reading probably, and look at the very top of it. And try to say out loud what kind of an account it is, okay? Not the company name, not your advisor's name, the actual type of account. And what we find over and over is that people genuinely cannot do that. They know it's their investment account, right? But they know there's a fee in there somewhere, probably, but their structure has a name, and almost nobody can tell you what that name actually is. And I'm not saying that to make anybody feel small, because honestly, it's not your fault. It's actually by design. The whole thing is built so you'll never quite get your hands around it.
Okay, but Megan, hold on. I have to push on that. Is that really the person's fault, though? I couldn't tell you the type of account my car loan is either, and I sleep just fine at night. Why does the name matter so much? Like, what does knowing the name actually change for me practically?
That is exactly the right question, Susan. And here's the answer. You cannot shop for something you can't name, okay? If I told you to go price compare that thing over there, you'd have no idea what to even look at, right? Or where to start. But the second you can say, I own a mutual fund advisory account, now you can ask what it costs, what it's returned, and whether something better exists. The name is the key that unlocks every other question. And the people selling these accounts are in absolutely no hurry to hand you that key.
See, that lands for me because I do that with everything else. I'll spend 20 minutes comparing two car seats with the exact same safety rating. But I wouldn't even know the brand name to type into the search bar for this. So Jerry, what is it? Give me the plain definition, the one that I could actually repeat to my husband at dinner tonight.
Let me put a clear definition on that, because once you hear this, you can't unhear it, okay? A mutual fund advisory account is an account where you pay an advisor an advisory fee, usually from, say, 1 to 1.5% a year for that advice. And then the advice is to put your money into a basket of mutual funds. Here's the catch. Those mutual funds, they already charge their own fee, and that's on top of the fee that you just paid your advisor. So you're paying a fee for the advice. And the advice points you straight to the products that charge a second fee, and sometimes even a third one. 2 layers minimum, often 3 layers. And the person sitting in one of those almost never knows just how it's being built and what's really underneath them.
Jerry, it's kind of like when you're the quarterback, you're the offense, and you're looking over across the line of scrimmage there, and it's a defense that disguises its coverage. The entire point of the disguise is so you don't know exactly what you're looking at until it's too late. The safety rotates right when the ball snapped. Here comes a nickel. You throw it where the hole was, and now it's a pick six going the other way. These accounts are built the same way. They're designed so the average person at the line of scrimmage can't read the defense, right? Can't know what's actually in the account. And if you can't read the defense, guess what? You got no shot at beating it.
Did you actually understand all that you just said?
Yeah, so you're looking at this and you think it's this, but it's not this, it's that.
Oh,
and this is that, and then that was this, and then,
I was referring to that nickel comment you made.
Okay, but here's what a lot of people are thinking, and I'll just say it. My advisor is a really nice guy. He remembers my kids' names, he sends a card at Christmas, and he's never once been anything but kind to me. So are you telling me the nice guy is ripping me off? Because that's a hard thing to swallow.
No, and this is so important. So I'm glad you said it out loud. Your advisor is probably a genuinely lovely person. And this is not about whether he's nice or she's great. It's about the structure he or she puts you in. A nice person can absolutely place you in a high-cost, low-flexibility account without a single bad intention, but it's just what their firm hands them to sell. It's what they have in their toolbox. The kindness is real. The Christmas card, it's real, but none of that shows up in your returns, okay? And none of it's lowering your fees by a single dollar.
And I'll tell you, I have a lot of buddies that are advisors, good men, they coach the kids' teams, good husbands, all that. But that's not the conversation. The conversation is whether the product they sold you is the best one for you or just the one on the top shelf that they have, kind of like Megan's saying. In football, we'd say he's a great guy, but he doesn't know what to do. He's lined up in the wrong spot. So he's going to make us lose. Like that guy needs to be my buddy on the bench, right? This doesn't need to be your advisor. Nice doesn't move the chains.
Okay, that reframes it for me. So if these accounts are everywhere and yours is so different, then I've got to ask the rude question. How do I even know your way is better? What's the proof, not the pitch? Because everybody on the radio says they're the best.
That's fair, and I'd be suspicious too. But here's the numbers, and basically they're posted publicly, so you'd never have to take our word for it. So through the end of last year, 2025, the accounts that Jared and I manage internally, they average a mere 36.3% for that 1 year period against the Dow at 13%. Again, 36.3 versus 13. Quite a gap. Over 3 years, we're at 19.3 versus 13.2 for the Dow. 5-year number, 13.3 versus 9.4 for the Dow. And an even longer number, period of time, 7 years, the one that really survived all these kind of market cycles, we're at 16.7% per year net of any kind of fee or cost. So 16.7 versus 10.1 for the Dow. Now, we said it a million times, past performance doesn't guarantee future results. Investment returns, they will vary based on the investment objectives and the tolerance for risk for each of those accounts.
Wait, 36% in a single year against 13 for the Dow? I'm not a numbers person, but I even know that's not a small gap. That's almost 3 times.
Almost 3 times, and that's not a hot streak. That's 7 years deep. The gap between this and the nameless account isn't luck. It's a completely different way of playing the game.
And Susan, those numbers don't come from luck, and they don't come from owning a little bit of everything. There's actually a name for owning a little bit of everything. We call it diversification.
Dun, dun, dun.
Yes, it's very doom and gloom. That's where you're so spread across thousands of holdings that you can't possibly beat the market because you basically are the market, just with fees stacked on top, okay? So the way this team gets those results is the opposite of that. It's selectivity. About 95 individual companies chosen on purpose at roughly 1% each. And if you don't believe the returns, go to theorganizedinvestor.com, where every account is posted with the last 4 digits of the real account numbers, so you can check the math yourself.
And folks, do not skip past what Megan just said. They post the last 4 digits of real account numbers right there on the website, so you can audit them yourself. You can look at them. Most firms would never do that. Well, most firms can't do that, and if they could, they still wouldn't. When somebody hands you the answer key and says, go ahead and check my work, that tells you something right there before you've even looked.
Okay, that's a fair answer, and I like that I can go verify it. But you keep pointing at this difference between your way and the nameless account way. Can you actually put a dollar figure on what that difference is worth to me? Because percentages kind of blur together in my head, and I think in dollars more than percent.
I can, and this is the heart of really why we do it this way. We have a simple little goal. Beat your prior advisor or some comparable benchmark by, let's say, at least 2% per year. Now, 2% may sound like a tiny little amount, almost not even worth talking about. But on a $1 million portfolio, compounded over 20 years, that little bitty 2% is worth roughly $485,000 of additional value. Folks, that's not a typo. This is a second retirement. Hiding in a number that most people just round off to nothing.
$485,000
chunk of change
on a difference of 2%. And that's the ball game right there. And it's why we're constantly obsessing over things that everybody else ignores.
So the 2% isn't them being fancy. It's them just refusing to leak money in 4 specific places that everybody else treats as normal.
And that $485,000 isn't magic, Susan. It comes from very specific things, 4 very specific places. 1, lower fees than a typical advisory arrangement. 2, lower costs by avoiding mutual funds, which means no expense ratios, no 12(1)(b, marketing fees, and no internal trading costs buried where you'll never see them. 3, less diversification. Those 95 carefully chosen names instead of thousands of indirect holdings stuffed inside funds. And 4, more selectivity, using the dividend growth companies we call the DSIP list and buying bargains when everybody else is panicking. Lower fees, avoiding funds, less diversification, and more selectivity. 4 sources, 1 big result.
Okay, $485,000 is the number that just made me sit up. That's not a fee difference. That's a house. So that's what's quietly on the table every single year I don't look at this.
All right, let me jump in right here because this is exactly the kind of thing that we want to talk to you about in person. Once a month, we host the Organized Investor Workshop, Chesapeake's right there on Parkside Drive, right in Knoxville, 6 o'clock in the evening. We have a meal, adult beverages if anyone wants to partake, and everybody walks out with a 60-page workbook. It's not a brochure. It's a real 60-page workbook, and we show you how to read your own statement. We covered the free estate planning that we offer that we'll get into shortly, and someone's leaving with an autographed football that I signed or some cool pictures that we bring as well. It's no pressure situation.
And on that estate planning, let me just plant the seed because we'll explain the whole thing later in the show. We provide a complete set of estate planning documents to listeners, completely free. There is no catch, I promise.
Did you say free?
It is free.
Free.
All it takes is 1 quick 5-minute phone call with us, okay? And you don't have to become a client. You don't have to come to the workshop, and you don't have to set foot in our office. But we do like to have that 5-minute conversation with you so we can make sure we are not leading you down a path with these documents that's not going to be a great fit for you. So for right now, just know that this offer exists and that it's free.
Free.
And Jerry, before we move on, can I get one of those things you know that the rest of us don't? You've been doing this for 43 years. Give us a little something we can take with us in the car.
So here's your smarter in 60-second little piece. See, when the small casual investor, the one that the market calls the odd lot crowd because they're buying a smaller number of shares, when they suddenly start piling into the stock market all at one time, that's generally a sign that the market is getting riskier, not safer, because the crowd tends to show up just at the right time, right when the party is starting to end and the police start to show up. So when everybody that you know starts constantly talking about some stock that's out there and how easy the market is, that's usually about the moment that you need to pay some close attention, not less.
That is when you need Jerry and Jared and Tennessee Wealth Management. So this is the stuff. That's 43 years talking right there. You don't get that little nugget from a committee or in another city that you've never met, some guy telling you this, that, or the other, or maybe a guy you like to play golf with. You get that from my man, Jerry.
Here's how I picture this whole nameless account problem. Imagine you walk into a pantry and there's a can sitting on the shelf with no label, just a plain brown wrapper. You don't know if it's soup or paint. You would never in a million years serve it for dinner. At least I hope you wouldn't. But that is exactly what most people are trying to do with their life savings, okay? They're holding a plain brown paper wrapper and they've been eating out of it for 15 years.
15 years of eating out of the unlabeled can. Ugh. And the wild part is the label was always right there. No one ever turned around to see it so they could read it.
And once you've read the label, you kind of can't unread it. That's the whole point of today, isn't it?
I sat with a woman a few months back. She was a lovely lady, a retired teacher like me. I don't really know that I could consider myself retired, but she was retired. And I asked her what kind of account she had. And she said, the good kind, I think. She'd been paying into a mutual fund advisory account for 11 years and she had no idea. And the second she could name it, the whole conversation changed. She stopped feeling protected by it and started asking questions about it. And that's the entire shift that we're talking about today.
That story honestly makes my stomach hurt just a little because that could absolutely be me. So let me ask the thing she probably didn't ask for 11 years. What is the holdup for somebody like her or like me? What actually stops a smart, capable person from just looking?
Let me put that right to the listener, and I'm actually going to wait for an answer. If you've got an account you can't name, paying fees you can't explain, what's the holdup for finding out? I'll wait for it. That's what I thought. That little bit of silence right there, that's the sound of a good question you've just never let yourself ask. When we come back, we're going to do something kind of fun. I think so anyway. We're going to hold one of these accounts up to the light. An actual example of one posted on our website, and Jerry's going to read it out loud, line by line, and you can see exactly what's hiding inside. Don't go anywhere. This is the Organized Investor Show, brought to you by Tennessee Wealth Management.
Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Wednesday, July 29th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend. However, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058.
Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
That's right. We're back. It's the Organized Investor Show, brought to you by Tennessee Wealth Management. It's me, Erik Ainge, Jerry Goodman, Megan Hubbard, and Susan Ainge. The voice of every listener. Stuck in traffic right now. Hope not. Not on your weekend. Before we break, we said most people own an account they can't name. A mutual fund advisory account. I feel like I should say that with some danger behind it. A mutual fund advisory account. This segment, we're talking about it in the abstract, and we can actually crack one open. Jerry, the floor is yours, because here's a real sample of one of these just sitting on the website right now.
For people's viewing pleasure. And that's right, Erik. On the investments page of our website, and that site is theorganizedinvestor.com. On the investments page there, we've posted a summary of an actual mutual fund advisory program that's available. So this is a real document dated June 30th of last year, 2025, and anybody can pull it up basically just in a few seconds and follow right along with us. Now, I'm not going to say the name of the program, and here's why. The name, honestly, it doesn't matter, okay? What matters is the structure. And this structure is absolutely everywhere. We see this all the time. So let's read it out loud, kind of like a stat sheet after a game, if you will, because the numbers on this program will tell you everything you need to know.
And I love that it's out there for the public, Jerry. Good work on that one. Or maybe I should say, Megan. Most firms talk about these accounts like they're a state secret. Tennessee Wealth Management posted a real one on the website and said, hey, check this out. Look at this thing. That's the opposite of disguising the coverage.
Okay, I respect that. If your numbers were ugly, the last thing you do is post a competitor's product right next to your own. So this is sort of a flex.
Well, babe, it's a flex. Confidence is putting the tape online and saying, compare away. Check this out.
Okay, I'm pulling it up on the website right now. What am I looking at first? Walk me through this like I've never seen a statement in my life, because most days, honestly, that is me. Where do my eyes even go first?
Perfect. Go to page 5. Now, page 5 is going to show the performance, and it basically says that this program returned 9.85%, that's 9.85 per year over the last 5 years. Now, hold on just a minute, because the 9.85% is before the advisory fee has been taken out. Now, let's say you knock off 1% advisory fee from that number. So your real rate of return now is down to 8.85% per year over that 5-year period. So right now, the gap, the headline number, is not the number you actually got to keep.
Wait, so the big number on the front, the one that probably made somebody feel good about signing up, isn't even the real number? It's already been shaved before I found a single hidden cost? That feels a little like a sticker price that conveniently forgets to mention tax, title, and fees.
That's the perfect way to say it, Susan. You know, the sticker is not the drive-off number from the lot. And here's the comparison that matters. Over that same kind of stretch, the account that our team has basically come up with was 13.3% a year net over that 5-year period. Now, again, past performance doesn't guarantee future results, and returns are going to vary by account, okay? But 8.83% versus from that program versus 13.3% for us, that's not a rounding error. On a real portfolio over a real retirement, that gap is the difference between a comfortable life and what can be a really tight one.
Right, because nobody quotes you out the door prices up front. They quote you the number that gets you to sign. Then the fees and the funds and the taxes are the dealer add-ons that you find out about later.
And just so everybody has the anchor in their head, okay, net of everything, this team did 36.3% last year against the Dow's 13% and 16.7% a year over 7 years against the Dow's 10.1%. Past performance is no guarantee of future results and returns vary by account. I can't say as fast as Erik, but I'm getting better at it. I keep saying the 7-year number on purpose, actually, Susan, because anybody can stumble into one lucky year, right? 7 years is a track record, not a coincidence.
Okay, got it. So the performance is lower than I'd want. But you keep promising me there are hidden costs underneath this thing. Where are those? Because I'm staring at this sample and I don't see one big scary fee anywhere on that page.
And that, Susan, that is the entire trick, okay? You're not supposed to see it. So let's flip over in this example to page 7. Now, buried in there somewhere are the internal costs of the funds, which, at this example, is 0.78% per year. Now, 0.78 may sound like also a rounding error, which is exactly why they write it that way in that tiny little decimal, versus a actual dollar number. So let me write this dollar figure down for you. On a $1 million account, 0.78% is equivalent to $7,800. That's this year, next year, every single year, just coming quietly out right off the top of that account. And really, that is on top of the advisory fee that you have already paid.
Hold on. Let me actually do this math on my own situation, because that's the only way it gets real for me. Say somebody has $600,000, not a full million. That's still what, around $4,700 a year? Coming out of an account every year that they never see leave and never approved?
Susan, you did the math a lot better than most advisors could, and you nailed it, okay? And stretch that over 20 years on a full $1 million portfolio. You're looking at roughly $156,000 just in internal costs on this, just from this one hidden layer. Not the advisory fee, not the taxes, not anything. Just the quiet little decimal number on page 7 that nobody ever circles for you. That's a paid off house gone just from a rounding error all at one time.
A paid off house. Let that sit for a second. In football terms, that's not getting beat deep once. That's giving up a little 5-yard slant on every single play until the game is out of reach. The damage isn't the big number. It's the small one, the repeated one for 20 years.
Okay, you said 12B1 a minute ago, and I just nodded like I knew what that was. Well, I don't. What on earth is a 12B1 fee, in English, by the way? Because if it's costing me money, I'd like to at least know what I'm buying.
Great question. And the answer is going to annoy you. I promise you it is. A 12B1 fee is a marketing fee. It's a little charge baked into a lot of mutual funds. And part of what it pays is for the cost of selling that fund to the next person. So in plain English, Susan, you can be paying a fee that helps the fund company go find its next customer. That is really annoying. You're not just the customer, you're actually helping fund the advertising budget. And it's listed in a prospectus that, let's be honest, not one human being in 1,000 years has probably ever actually read that. Unless you're, I guess, looking for a sleep aid.
True.
Buying the billboard that sells your own neighbor the same fund, I'm going to steal that one. I like it.
I'm sorry, I'm paying for their marketing? That is generally the most Tennessee thing I've ever heard. Like buying the billboard that sells your own neighbor, the same thing. Okay, what else? Because at this point, I just assume there's more.
There's more, and here's the part that gets me as a former teacher, because it just really isn't fair. Those fees come out whether the funds go up or whether the funds go down. You can have a losing year, your account is actually down, and the fee gets pulled out anyway, right on schedule. Imagine sitting down at a restaurant, sending the meal back because it was cold and wrong, and then getting charged full price for it anyways. That's a mutual fund advisory account in a bad year. You paid full price for the meal you sent back.
That one is going to stick with people, Megan. You sent the food back and they still ran your card, and nobody at the table even told you that it happened.
Okay, that is the one that actually makes me a little mad. But is there anything beyond the fees? Like, does this structure cost me in ways that aren't even printed on the fee line? I feel like you're about to tell me yes, so I'm bracing for it.
2 big ones, yes. First, every December, those funds basically can hand you a capital gain tax bill for trades that the fund manager made maybe earlier in the year on stocks that you never even personally owned inside of it while you were there, okay? You can even be down for the year and still owe tax on what somebody else was trading earlier in that year. Second, the funds are slow. Say a committee meets, every so often, maybe to consider a change while the market is basically already moved without them.
Hang on, a tax bill in December for trades I didn't make on stocks that I didn't pick? How is that even fair? That feels like getting a parking ticket for a car that you don't even own.
Well, compare that to in-house management. When the AI software stocks started hitting the market over the last year, the good companies really got thrown out with the genuinely troubled ones. So Jared and I could actually move in a particular morning, not particularly over a quarter, but very quickly. The speed is the difference in between catching the sale and reading about it after it's already gone. Say, a committee cannot sprint. We can. And in this business, the difference between doing something one morning versus next quarter, it's real money.
Faster is the part nobody markets, but it's huge, huge. When the AI sell-off hit, the slow money was still filling out a form while the fast money was already buying the bargain. Same headline, completely different outcome, different approach. You know what reading the sample reminds me of, Jerry?
What's that?
Not a funny joke. I'll tell that later. Watching film in football. In football, the box score lies to you. Stats can too. It says you scored 24 points. And you go, hey, well, I feel pretty good about that. Then you put on the film Monday morning and you see that you left 21 more on the field with drop passes, blown assignments, drop balls. This sample is the film. The headline says 9.85%. But the film shows you what actually happened to your money once everybody took their cut.
Okay, the film thing actually helps me. The scoreboard said one thing, the tape said another. So my statement's been showing me the scoreboard this whole time, not the tape?
Exactly. The scoreboard is the brochure. The tape is the statement, and almost nobody ever watches their own tape when we're talking about investing.
And Erik, this is exactly where that 2% improvement comes from, by the way. So remember, roughly $485,000 over 20 years on $1 million portfolio. And it comes from 4 places: lower fees, avoiding funds, less diversification, and more selectivity. Reading this one sample, you can literally watch the first 2 of those leaking out of the bottom of the account. That's on page 5 and page 7, by the way.
Quick timeout. Give me a 20. Because if reading a statement out loud sounds useful, that's the entire vibe of the workshop. That's right. Organized Investor Workshop, Chesapeake Parkside Drive, 6 o'clock, once a month with a meal, a couple of adult beverages. Hey, Jerry, last time we had one of these with the adult beverage, did you know a mushroom came to the workshop to the bartender?
Yeah, but I don't think they could serve him, could they?
They couldn't. You know why?
Why's that?
Well, he said, you should serve me. I'm a fun guy.
Oh,
Huh?
Love it.
And Jerry's got a million more of those. I learned all of these from him. One lucky person's also going to get a signed football. There's some autographed pictures from me. It's an education event to meet us. It's not a sales dinner. Book right there. A book. That sounds like it costs money. It's free. RSVP at theorganizedinvestor.com or call 865-415-2058. And on the estate planning, I'll say it again because people don't believe us when we say this. It is completely free. 1 5-minute phone call. You don't have to be a client or attend the workshop or even come to the office, although I recommend all of those. Jerry's going to give you the full rundown of the last segment, but for now, just file that away in the back of your mind.
I'll be honest, the word free makes me a little suspicious, so I'm glad you're explaining it later. Usually when something's free, I'm the product. But okay, I'll hold my questions.
Hold the suspicion there. It's healthy, and Jerry's going to earn it back in the last segment. For now, let's go back to the leaks.
Jerry, can I get another smarter in 60 seconds while we're rolling? Something that I can actually see. Something that I can actually use, not just nod along to. Teach me one real thing before the break.
You got it. And here's your smarter in 60-second kind of little part. Rising interest rates can make it a real headwind for stocks because higher rates make it harder for those companies to earn the kind of profits they would normally get when interest rates were cheaper. So when you hear the rates are climbing, don't panic, but do understand why the market does get kind of jumpy about it. And the reaction usually has a reason underneath it.
That right there is the value of over 43 years in one breath. Actually, it was like 6 breaths, but it was worth it. A committee in another city reads you a headline. Jerry tells you why the headline is moving. One of those actually helps you get sleep at night.
So let me make sure I've got the whole picture before we go. Lower returns on page 5, a hidden cost on page 7, a marketing fee I'm somehow paying, fees that come out even in a down year, a surprise tax bill in December, and a manager too slow to act. Did I miss anything? Because that is a lot of leaks in one boat.
Susan, you got it almost perfectly. And you just did something that a lot of people, they'll never do, okay? You added it all up and you did it in one place. And that's a real problem with all of these accounts. Each piece is kind of small enough just to ignore it on its own, but nobody ever stacks them on top of each other like you just did. So individually, every one of these is really easy just to kind of forget about, just wave away. Stacked up, it's the difference between an average retirement and what can be a great one.
And that's the quiet genius of how these things are built. No single fee is big enough to make you pick up the phone and fight it. They all just sit under the line where you'd never even look. Death by 1,000 paper cuts, or in this case, death by 1,000 decimal points.
Decimal point, maybe.
Decimal.
Death by 1,000 decimal points. That's exactly it, though, isn't it? No single number ever made me angry enough to act, so I just never acted.
So here's the thing. You just heard exactly how to find the hidden cost on your own statement. Page 5, page 7, is what Megan was saying. What are you waiting for? Pull it out tonight. Just look. Nobody's asking you to fire anybody or move on a single dime. Just look at this thing that you've been paying for. Because here's where we're headed next. And it's the most important part of the whole hour. Naming the problem feels good for about a day. Fixing it is what actually changes your retirement. In the final segment, we're going to talk about what you do once so you can finally name this thing. Stick with us. It's the Organized Investor Show, brought to you by Tennessee Wealth Management. We roll on.
If you're interested in a more personal learning experience, join us at an Organized Investor Workshop. Erik Ainge and the entire team will be there. The next event is scheduled for Wednesday, July 29th, 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. Attendees will receive a 60-page workbook, a yummy meal, and learn how to get free estate planning documents through our partner, Trust and Will. Seating is limited, so reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058.
Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
You got to name it to refuse it. Welcome back to the Organized Investor Show, brought to you by Tennessee Wealth Management. This our final segment. It's me, Erik Ainge, joined by Jerry Goodman, 43 years, and a CFP, Megan Hubbard, the teacher, who's making it all make sense, and Susan, asking exactly what you're thinking right there while you're listening. Quick recap. We said the most common account in America is one nobody can name, a mutual fund advisory account. Then we showed you how to spot its real cost on your own statement. This segment is about the only thing that actually matters now. What do you do once you can name it? So, Megan, the ball's yours.
Thanks, Erik. Here is the simple truth, okay? So you can't refuse what you can't name. For years, the reason people stayed in these accounts wasn't loyalty, and it wasn't even fear, really. It was that they never had the words to push back on what they didn't know. So today, you have the words. And refusing it from here is just a few specific moves. And the very first move isn't even leaving anybody. It's just comparing.
And I want to underline that because it's the whole point of this segment. Refusing doesn't mean storming in and firing somebody on Monday morning. It means doing the one thing that you've never done, putting your account side by side with a real alternative, comparing. You compare trucks, you compare houses, heck, you compare where to get lunch. This is just some film study on the most important thing you actually own.
Film study. Okay, so step 1 isn't quit. It's just watch the tape. That feels doable. I think people freeze because they assume step 1 is the scary part. Okay, comparing. But comparing what exactly? If I sat down at my kitchen table tonight, I genuinely don't know what I'd even put side by side. Give me the actual homework, like you'd give a first grader, step by step.
3 things, and you already have all of them in the house, okay? So number 1 is your return. You should have that in your house or on your computer. What did your account actually do over 5 and 7 years, net of every fee? Number 2 is your total cost, not the advisory fee on the agreement, but the all-in cost, including that fund layer we read off of on page 7. Number 3 is your flexibility. Ask whether anybody can actually buy or sell an individual stock for when there's a sale, okay? Or whether you've locked yourself inside these funds that a committee actually is controlling. Put those 3 things next to our posted numbers and you've just run the comparison that almost nobody ever runs. That's it. That's the whole homework. It's actually pretty simple. And here's what's wild, Susan. Most people will spend more time comparing 2 hotels for a long weekend than they've ever spent comparing the account that holds their entire life savings. Same brain, same person, just never pointed at the thing that actually matters the most.
Okay, return, total cost, flexibility. I can write those 3 on a sticky note tonight. But here's my dumb question. Where do I even find the total cost? You just said the agreement won't show it.
That is not a dumb question at all. I actually used to tell my first graders, like, there are no dumb questions. Somebody else might be thinking the same thing. And so it's always good to ask questions. We learn from questions. So the advisory fee is on your agreement, okay? But that fund layer, that page 7 number, usually lives in the fund's own fact sheet online. Or, easiest of all, you bring the statement to us and we find every single layer for you in about 15 minutes. That is literally the thing that we do. My dad loves to investigate.
So fun.
Dun, dun, dun. And notice what just happened. The thing that felt impossible at the start of the hour, comparing your own account, Megan just turned it into a sticky note in a 15-minute meeting. That's the whole trick from this stuff with Tennessee Wealth Management. The big scary monster is usually 3 small steps that you've just been avoiding.
And if I do all that and I find out I've been overpaying for years, am I going to feel stupid? Because I think that exact fear is what keeps a lot of people from even looking. Nobody wants to find out that they got taken, especially by somebody they trusted.
That is such an honest thing to say, Susan. And no, you shouldn't feel stupid for 1 second. These accounts are designed by very smart people, specifically so you won't look, okay? So it's on purpose. That retired teacher I mentioned earlier in the other segment, when she finally saw it, she didn't feel dumb. She felt free. She actually moved her account, and the first thing out of her mouth was, "Why did nobody just show me this?" That's the whole reason we do this show, honestly, not to make you feel behind, but to hand you the words that nobody ever bothered to give you.
And that's it right there. No one is calling you behind. The game just had a rule book that you were never handed. So, like Megan was saying, here we are, all 4 of us, handing you the playbook.
Can I admit something a little vulnerable? Part of what keeps me from moving anything is just plain guilt. This advisor has been with my family for years. It honestly feels like I'm breaking up with someone.
That is such a human thing, and you're completely allowed to feel that way. But here's a gentle reframe, okay? So your advisor's livelihood is not your retirement's responsibility. You can be grateful to someone and still decide their product isn't right for the next 20 years of your life. Loyalty to a person should never quietly cost your family $485,000.
And a good advisor who actually cares about you wants what's best for you, the best thing for you. If moving your money offends them, well, he just told you everything you needed to know.
That's a good line. A good one wants what's best for you. Okay, I think you've officially talked me out of my own excuse, but here's the practical fear underneath the emotional one. Isn't actually leaving going to be a huge hassle? Like, am I going to get hit with a giant tax bill or spend 6 months buried in paperwork just to move my own money? I think that's the part that quietly keeps people frozen.
You know, it's a fair worry. And here's the honest answer for that. Most of the time, moving an account is far less painful than people are actually going to fear. And a lot of it really can just transfer from one firm to another, just as is. On the taxes, in a retirement account such as an IRA, repositioning from one firm to another is never going to trigger any kind of tax consequence. In a taxable account, sometimes selling a big winner means paying some capital gain tax along the way. But I'll tell you basically what we tell clients. Owing taxes because you grew it a lot last year, it's kind of a nice problem to have, isn't it? And the bigger mistake is staying in somewhere rather expensive for years just to avoid, say, a one-time bill that you happily pay if you just saw the full math on everything.
Okay, that actually lowers my blood pressure just a little. So the tax thing isn't a trap door. It's just a one-time line item I might have to plan for. And in a retirement account, often not even that.
Right. And think about what the fear of that one bill has cost people. They sat in a high fee account for 10 extra years just to dodge a tax they'd have paid one time. That's punting on first down because you might take a sack.
And my dad's absolutely right that most of the time it's far smoother than the horror story in your head that you've created. The fear is almost always bigger than the paperwork.
So here's where we run into that comparison. And here's the yardstick that we can hold this up to for you to look at. 36.3% was our return for last year for the net return versus 13% for the Dow. We're at 16.7% a year over a 7-year period versus 10.1% for the Dow. Past performance doesn't guarantee future results. Returns vary by account, all of that. But these are posted with the last 4 digits of each real account number on our website, theorganizedinvestor.com. So the comparison isn't really just talking about it. It's really just for you to check. And that's the whole point. You don't have to trust us. You just have to take a look. It's really pretty simple.
And that to me is the most confident thing that we do, right? We're not saying trust us. We're saying, hey, check on us, right? You put the tape online and dare you to watch it. Hey, here's what we're doing. Why don't you look at it, please?
And if that comparison turns up a gap, remember that gap has a dollar value attached to it. That's the 2% goal again, roughly $485,000 over 20 years on $1 million portfolio coming from those same 4 places. Lower fees, avoiding funds, less diversification, and more selectivity. Refusing the nameless account is simply how you stop handing that $485,000 to somebody else.
And if you want help running that comparison with real people in a room, come to our workshops. Once a month, Chesapeake's Parkside Drive, 6 o'clock. It's a meal, adult beverages, 60-page workbook. We sit down with you. You can bring your statements. We can talk about it. You can set up a time to go to lunch. Jerry's a food pusher, and he loves taking people to lunch. And he's the one that's got all this information, like I said, over 43 years. You get to come and meet all of us. Megan and Jared and me and Susan, we'll all be there. We cover the free estate planning. Someone's going to win a free football. We're going to bring some cool pictures. And like I said, this is not a sailing, hard sell, steak, type thing. This is a meet and greet.
It's a fun
thing.
Let's call it a fun fest.
It is a fun fest. Yeah. And we really look forward to doing these. RSVP at theorganizedinvestor.com or call 865-415-2058. Megan, the whole comparison idea, that's just watching film on your own team. Like from the best quarterbacks that I've ever seen, or when I was at my best. We weren't the most talented guys necessarily. It was the ones that studied the film and their own tape, found the ugly habit, fixed it before the next big game. That investment. Most investors, though, will study everything except their own portfolio. It's kind of what we've been talking about. They'll research a new truck for 3 weeks, which Airbnb they're going to go, but they won't pull their own statement and run the film on themselves. That's how you win the second half of your financial life.
The second half, because honestly, it feels too late sometimes, like the game's already decided. You're telling me it's halftime, not the final whistle?
Yeah, halftime. Down a couple scores maybe, but you've got the ball and plenty of clock. The worst thing you can do at halftime is just keep running the same losing play because you know how that's going to end.
Run a new play. I came in today thinking this account was just the way things are, and now it feels more like a choice I've been making by not choosing.
That might be the smartest thing said in the studio all year, and you just nailed it. Hey, a choice you've been making by not choosing. Write that one down too.
All right, Jerry, one more smarter in 60 seconds before you let us go. And send us out with something good, something I'll actually remember tomorrow.
Happy to. So let's get your smarter in 60-second comment out of the way here. Most people, they get drawn into the market as it's rising, and then what happens? They get scared as it starts to fall, which is exactly backwards from how you're actually supposed to make some money and build wealth in this whole process. The folks who do well decide what they're going to do before the emotion hits them, okay? Not during the event. So you name your plan in advance, and the market can basically never talk you out of it.
Decide before the emotion hits. Somebody write that on the bathroom mirror. All right, Jerry, before we run out of time, the thing we've been promising all hour, the estate planning. Give the people the whole thing start to finish.
Here we go. 75% of the people listening to this show right now, one of two things. Either they have no estate plan documents done at all, or basically they're out of date. It's one of those two things. So here's what we have to offer to help solve all of that. We have an unlimited annual subscription with our online partner called Trust and Will. We pay a lot of money for this. It's unlimited. And we basically can provide and help you get a complete set of estate planning documents to our listeners completely free of charge, no cost, no obligation. Now, that could include a durable power of attorney, healthcare power of attorney, an advanced healthcare directive, and then either a will or revocable living trust, whichever one you choose. And basically, that's for you, also for a spouse if you have one of those lying around, and it's valid in all 50 states. Now, it's the right fit for about 95% of the people out there. And the 5% who have a truly more complicated situation, we're happy to introduce them to a flat fee attorney if they need an attorney actually involved in it. And we've done this for more than 25 years. We've never made a dime off of it, not once. And the biggest thing we run into is people, they don't believe that it's free, but it truly, truly is.
Wait, free? What is the actual catch? And what do I have to do? Because in my experience, the word free usually comes with a paragraph of fine print.
No catch at all. Here's all you have to do. You need to call me or call Jared, my son-in-law, and all we want to do is have a brief little 5-minute conversation with you to figure out if you're in that 95% of the group where you're in a simple situation, this will work for you, or if you're in the more complicated 5% group where you actually need to be dealing with an attorney. We don't want to waste your time. We're just doing some due diligence to make sure that this trust and will option is kind of right for your situation. Now, at that point, if we send you the link, you can do this completely on your own. You can do it with a little bit of help from us. Or basically, you can come in and we'll kind of walk you through the whole thing in our office if you want to. You don't have to be a client. You don't have to attend the workshop. You don't have to do anything, okay? And here's the reason not to wait. Because the day that you actually need this, guess what, folks? You can't get it at that point. If you have a stroke tomorrow, if say tomorrow morning, you can't go out and sign a healthcare directive or sign a power of attorney at that point in time. It's too late. So call me directly, work number of 865-415-2070 for that 5-minute little chat. That rings straight to my cell phone number. Again, 865, which spells VOL.
I was going to beat you to it.
Sorry, 865-415-2070.
Okay, you actually answered the catch. There isn't one. 5-minute phone call. You tell me 95 or 5, and either way, I walk out with a plan. I genuinely don't know why anyone wouldn't make that call.
And that's the perfect setup for the only question that I've got left. Okay, here's my last challenge to you, and then we'll let you guys go about your weekend. You wouldn't wait 15 years to fix a leaky roof over your kid's head, and your family is the roof. And remember, this one is free. Free is the floor. It cannot get cheaper than that, y'all.
And that's really the heart of the whole hour, isn't it? Whether it's the nameless account draining a little every year or the estate plan you keep meaning to get to, the cost of waiting is always bigger than the cost of acting. You just couldn't see it before because nobody gave you the words. Now you have them, so use them.
Use them. That's the whole assignment. Not next year, not after the next statement lands, this week.
You know, sitting here as the newest one at this table, that's the thing that stuck with me all hour. I'm not behind because I'm dumb. I'm behind because nobody ever handed me the vocabulary. And once you have the word for the thing, you can't go back to pretending you don't see it.
Couldn't have said it better, and that's exactly why we do this. So here's our hour in one breath. The most common account in America is one most people can't name, and now you can. Name it, question it, and if it doesn't measure up, refuse it. You got to run that comparison. To run that comparison or just get your statement decoded by a human, come to the workshop, RSVP at theorganizedinvestor.com. If you don't want to wait till the next one, you can always just call Jerry, like you said earlier, 865-415-2070. Or if you want to RSVP for the workshop, call 865-415-2058. All this can be found at theorganizedinvestor.com. And to grab that free estate planning, again, call Jerry, 865-415-2070. For Jerry, for Megan, for Susan, for me, thank you for spending some time with us on the Organized Investor Show. We'll see you next week, or maybe at the workshop.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or Tennessee Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Erik Ainge is the host of the Erik Ainge Show on 99.1 The Sports Animal weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management in Knoxville and Prospera Financial Services in Dallas, Texas. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. Brokerage and advisory services are provided by Tennessee Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by Tennessee Wealth Management for educational platform purposes.
Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Wednesday, July 29th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend. However, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058.